Based on all my conversations with Palantir employees and former Palantir employees, this is not truly a generative AI company.
People are like, yeah, the stock is down, that we're doing crazy important things, and the alternatives suck.
Palantir stock had massive gains that many investors don't have a clue about. Many analysts agree that it will make millionaires out of those who invested in it after a historic earnings report. With so much upside, why did Palantir stock drop over 15% after their latest earnings call? Let us explore the millions that Wall Street might be missing. The real story behind Palantir's market turbulence. You see, high expectations are a big part of the story. Palantir has been hyped up, and when expectations are so high, even good news can lead to a sell-off if it doesn't meet sky-high hopes. The initial stock price jump reflects the good earnings report and optimistic forecast, but this quickly faded. Investors may be nervous about Palantir's ability to maintain such high growth rates and broader worries about tech stocks. The AI field is highly competitive and changes fast. Investors might be unsure if Palantir can stay ahead of rivals like Google and Microsoft. Even with impressive platforms, questions about how Palantir will continue to grow and compete might be causing concern. Wall Street looks at both current performance and future potential, and there seems to be some doubt about Palantir's long-term prospects. Don't forget broader market trends. Tech stocks have been volatile and under scrutiny. Concerns about regulations, rising interest rates, and geopolitical issues all contribute to investor anxiety. Strong earnings reports can't completely protect companies from these broader economic worries. Generative AI is often seen as a groundbreaking technology, with companies like Palantir benefiting greatly from the hype. However, the actual situation is more complex. For instance, Palantir's US commercial growth was 70% last quarter, but dropped to 40% this quarter. This suggests that the initial high growth might have been due to easy comparisons and one-time events rather than ongoing success. Additionally, government agencies are starting to reduce their reliance on Palantir, preferring to use multiple vendors to manage risks and improve service diversity. This change could lead to mixed results for Palantir's government business in the next few years. While government contracts are usually more stable, they don't offer the same high-growth potential as the commercial sector. This likely explains why Palantir focuses more on commercial growth despite its unpredictability. Some analysts, like Rishi Jaluria from RBC Capital, believe Palantir is overhyped and have set a modest $5 price target on its stock. A common issue with mainstream finance media is that they rarely fact-check analysts' claims or challenge their points thoroughly, often accepting optimistic projections without much scrutiny. This gap between the company's presentation and media portrayal highlights broader industry trends. Executives like Karp deeply understand their company's operations and present a vision of transformative technology. Meanwhile, media outlets often simplify these stories, missing important details. Finance experts are buzzing about Palantir's latest earnings, focusing on the Rule of 40. This metric evaluates early-stage SaaS companies by combining their growth rate and profit margins. But let's dig deeper. A 21% revenue growth plus a 36% operating margin gives a Rule of 40 score of 57, which seems remarkable. However, the Rule of 40 isn't flawless. It's designed to offer a quick snapshot of a company's financial health, beyond the often misleading price-to-earnings ratios. Even with a high price-to-earnings ratio, a SaaS company might still be fairly valued if their combined growth rate and profit margins exceed 40. Let's explore the real story behind the numbers. Decoding the Rule of 40. For example, Palantir's 21% revenue growth sounds strong, but can it continue at this pace? Similarly, a 36% operating margin is impressive, but how sustainable is it? Are they cutting costs that might affect future growth or employee morale? Take Splunk, recently acquired by Cisco for $28 billion. Though don't have Splunk's exact Rule of 40 score, such a major acquisition suggests strong financial health, likely a high score. This puts Palantir's 57 into perspective. It's good, but how does it compare to industry leaders and peers? Palantir's 50% increase in operating margins year over year shows financial discipline. But this rapid improvement raises questions. How did they achieve it? Were there significant cost cuts that might impact future growth? These aspects are often overlooked when focusing solely on the Rule of 40 score. Adobe has a solid Rule of 40 score of 52, while CrowdStrike and Salesforce both score 40. UiPath is a bit lower at 36, with Shopify and Dropbox at 31 each. Zoom is trailing with just 15. Achieving higher scores gets progressively harder because companies need to maintain very high growth rates or operating margins as their markets grow and competition increases. This is why most companies on this list have either high revenue growth or high margins, but rarely both. Palantir stands out with an impressive score of 57. Their revenue growth has been accelerating over the past 4 quarters, showing increases of 133%, 17%, 20%, and 21% year over year. In their commercial sector, revenue grew by 27% overall and 40% in the US. Soon, Palantir is expected to make more money from commercial clients than from government contracts, which is notable given the smaller market size of government agencies. Commercial businesses tend to make large software and subscription purchases at the end of the year to lower their tax liabilities. The US government's fiscal year starts in October, influencing when purchases are made. Palantir's ability to navigate these timing nuances and maintain strong growth in both government and commercial markets shows their strategic skill. Agencies and military branches often get their budgets at the end of the year, making the fourth quarter the best for growth. But Palantir saw even faster growth in the first quarter thanks to their AIP bootcamps. These are hands-on sessions where participants work with Palantir engineers to build real solutions using their company data in just a week. Many people overlook the power of these boot camps, a mistake I made last year, which is why I'm discussing it now after seeing a clip on Yahoo Finance. Rishi from Yahoo Finance talked about Palantir's boot camps and their smart strategy. However, he advises being cautious. Palantir services are highly customized, with over 30% of their business focused on professional services and outsourced data science, not just software. This customization makes the bootcamp model less straightforward. Palantir's earnings calls suggest these bootcamps quickly turn attendees into big clients, but that's not the case. These bootcamps don't instantly turn participants into major Palantir clients. It's a longer process. Participants often need multiple boot camps to reach that level of investment. The heavy customization required for each client means these boot camps are just the start. The transition from boot camp attendee to a significant Palantir client involves many steps, including deep integration and ongoing professional support. This makes the optimistic projections from earnings calls seem overly simple, revealing a slower and more complex growth path. The claim that AIP bootcamps are game-changing seems like a marketing tactic rather than a true innovation. These bootcamps are advertised as a breakthrough, allowing experts and decision-makers to use their own sensitive data to build AI tools and workflows tailored to their needs. In theory, participants leave with AI use cases almost ready for production and the skills to implement them. However, the actual impact is often less impressive. Palantir partners can run their own boot camps, acting as an extension of Palantir's sales force. This helps accelerate AIP adoption, but is more about expanding sales reach than technological advancement. The real benefit seems to lie in sales tactics rather than any substantial technological leap. Alex Karp's claim that the surge in demand for Palantir's platforms is driven by this hands-on, market-oriented strategy needs scrutiny. While these boot camps are promoted as proof of the company's ability to deliver results, many companies could achieve similar outcomes with other AI solutions without such intensive sessions. The effectiveness of these boot camps in producing long-term benefits for companies is questionable. Are these AI use cases truly ready for production, or are they just prototypes requiring significant refinement? The promise of hands-on experience sounds enticing, but the reality often involves a steep learning curve after the boot camp, dampening initial enthusiasm. Market reactions reveal hidden truths. The reality of Palantir's AI capabilities. Numerous other companies offer similar training and integration services, challenging Palantir's claimed competitive edge. The focus seems to be on creating a perception of exclusivity and cutting-edge capability, while practical outcomes might not match the hype. This strategy might boost adoption rates in the short term, but raises questions about sustainability. Is making partners an extension of the sales team a genuine value addition, or a way to mask the need for a more robust product? The emphasis on hands-on, market-focused strategies sounds compelling, but it might be more of a sales pitch than substantial progress. In reality, these boot camps, while beneficial in some ways, are not as revolutionary as claimed. Instead, they represent a sophisticated marketing tactic designed to drive adoption and create an aura of innovation around Palantir's offerings. Marketing has always been a weak spot for us. Could list 50 things do better than our competitors, but there are also technical innovations we've developed that many people don't yet understand or appreciate. It's more effective to show the value of our products directly. But don't just take our word for it. Let's look at the data. Palantir's US commercial customer accounts have jumped by an impressive 69% year-over-year and 19% quarter-over-quarter, even though Q4 is usually their strongest quarter. This growth is clear in the 136 US commercial deals Palantir closed last quarter, averaging more than one deal a day. This is almost twice as many deals as they closed during the same time last year. This increase in Palantir's growth isn't by chance. It picked up significantly after they started running these AIP boot camps in earnest. These boot camps are designed to showcase their technical skills and real-world applications, and they have clearly connected with clients. However, while the numbers show success, they also highlight the challenges in showing the full scope and potential of Palantir's technology to the market. Despite these gains, the complexity and advanced nature of Palantir's technical offerings often go unnoticed. Many of the innovations driving these impressive numbers aren't immediately obvious to the general public. This makes practical demonstrations and real-world applications crucial to showing the true value of what Palantir offers. The data highlights the gap between Palantir's capabilities and market perception. While the growth figures are positive, they also reflect a broader issue in the tech industry: the struggle to communicate the full value of complex innovations. As Palantir continues to close more deals and expand its customer base, the challenge remains to bridge the gap between technical expertise and market understanding, ensuring that the true potential of their technology is recognized and appreciated. If that's not the definition of a game changer, I don't know what is. Let's explore why there's such a big gap between Palantir's earnings call and how the mainstream media has been covering it. Rishi, you're clearly not a fan, giving the shares an underperform rating. We see the stock coming back to earth today, but the market hasn't been on your side so far this year. Despite this, the stock has rallied, and it's clear there are many enthusiastic buyers out there. So where does this gap lie between the perception of Palantir as an AI leader and your view, which is much less optimistic? It boils down to that perception. Palantir has managed to create an image of being at the forefront of AI innovation, riding the wave of hype that surrounds anything labeled with artificial intelligence these days. However, the numbers tell a different story. While the company's technology might be impressive, it's the financials and operational performance that ultimately matter to investors. The hype can only sustain a stock for so long before the underlying fundamentals need to justify the valuation. Many buyers are swept up in the allure of AI potential, often overlooking the more mundane yet crucial aspects of business performance like profitability, cost management, and sustainable growth. Meanwhile, mainstream media often prefers the sensational story. They highlight the cutting-edge tech, the potential for revolutionizing industries, and the charismatic leaders behind the company. It's a story that sells, one that's easier to digest than the dry analysis of balance sheets and income statements. This creates a gap between the sensationalized media portrayal and the grounded, critical view held by more skeptical analysts. Moreover, the broader market sentiment has been buoyant this year, with investors flocking to tech stocks in search of the next big thing. This has lifted many boats, including Palantir's, despite the less-than-stellar financial reality. The gap, therefore, lies not just in the media coverage, but also in the broader investor sentiment, which often operates on optimism and potential rather than cold, hard facts. Palantir and AIP's bold claims about leading the generative AI space have drawn skepticism from AI and machine learning experts. These technologists see a clear gap between Palantir's marketing and their actual capabilities. Palantir promotes itself heavily around AIP and organizes boot camps, seemingly targeting retail investors to capitalize on the current AI investment trend. Experts argue that while Palantir may offer useful tools, its portrayal as a leader in generative AI is overstated. The term cutting edge suggests groundbreaking innovation, but Palantir's products do not match these high expectations. This difference between marketing and reality is a concern for potential investors. The AI landscape is indeed transformative, but not all companies are as advanced as they claim. For investors, this calls for a careful approach. Palantir's offerings might be helpful, but it's essential to separate effective marketing from actual innovation. The risk lies in mistaking promotional hype for real technological progress. Investors need to critically assess whether the company's products live up to its ambitious claims. The gap between Palantir's marketed image and the skepticism from experts highlights the need for thorough research. Microsoft is heavily investing in generative AI, partnering with OpenAI, a key player in the AI field today. This collaboration makes Microsoft a leading figure in AI, suggesting it might be a better investment than Palantir. While Microsoft and OpenAI explore the potential of generative AI, Palantir takes a different approach, focusing on practical uses instead of the hype. Media hype versus reality. What's really happening? The promise and pitfalls of simplifying AI integration. The market's excitement about generative AI, driven by companies like OpenAI and their partnership with Microsoft, is quite different from Palantir's practical approach. Palantir's technology aims to provide real value through advanced data analysis and integration, appealing to those looking for concrete results rather than speculative trends. As AI develops, the different paths taken by these tech giants show the various ways AI can be used, with Microsoft and OpenAI pushing innovation in generative AI, while Palantir focuses on practical, impactful data solutions. Managing science across an entire organization with a consistent real-time view of enterprise data sounds like a dream. Companies use digital twins or ontologies, which are fancy maps showing a company's resources and their connections. This aims to give a clear, big picture for large, complex enterprises. Palantir platforms claim to help companies build and use these ontologies to analyze vast amounts of data, track inventories, assets, and resources, and optimize logistics chains, manufacturing processes, and other operations. It sounds perfect for multinational, multi-billion-dollar companies with countless moving parts. These platforms promise to turn chaos into order, making it seem like managing all your enterprise data is a breeze. They claim to give you the tools to optimize every aspect of your operations, from logistics to manufacturing. But anyone who's actually used these tools knows the reality is far less rosy. The platforms often add a new layer of complexity rather than simplifying things. The idea of having a real-time, clear view of your enterprise data is appealing. Who wouldn't want to make informed decisions based on up-to-the-minute information? But the truth is, implementing these systems is a massive task requiring significant time and resources. Even then, there's no guarantee that the promised efficiencies will appear. These tools are marketed as the ultimate solution for big corporations, promising to untangle the web of data and operations that come with running a global enterprise. But the irony is they often add to the complexity, making it harder to achieve the efficiency they seek. AIP might offer some relief by making these systems more accessible, but it doesn't remove the underlying complexity. In today's world, companies are relying more and more on AI to make their operations smoother. AIP claims to be the perfect link between company data and AI models. Instead of coding or creating datasets and dashboards by hand, users can interact with their company's data through simple prompts, similar to how they would use ChatGPT. But it's not limited to just ChatGPT. AIP works with any large language model that a company prefers. AIP promises to set rules and limits, making sure models only access the right data, use the correct tools to calculate answers, and reduce mistakes. Artificial intelligence is changing how we live and work in many ways. First, there's generative AI. Imagine having a computer that can create new things like a writer or an artist. This AI can write stories, make pictures, and even create videos. For example, tools like ChatGPT can help you write essays or emails just by typing in what you want. Big companies like Microsoft and Google use these AI models in their products to help people create documents and presentations quickly. In the movie industry, this AI is used to make special effects look real, like making actors appear younger or creating new characters out of thin air. Next, we have machine learning, which is like teaching a computer to learn from examples. Instead of telling it exactly what to do, we give it lots of data, and it figures out patterns and makes decisions on its own. This is useful in many fields. In healthcare, it can predict diseases by looking at patient records. In finance, it helps catch fraud by spotting unusual transactions. In retail, it learns what customers like by analyzing their shopping habits. Machine learning helps businesses make better decisions because it uses insights from lots of data. Then there's robotic process automation. This is about using AI to do boring, repetitive tasks that humans usually have to do. Imagine a robot that can handle tasks like entering data, processing transactions, and managing records without getting tired or making mistakes. This technology is especially helpful in banking and healthcare, where there are many repetitive tasks. By automating these tasks, companies can save time and reduce errors, making everything run more smoothly. Deep learning is another exciting area. This type of AI uses a kind of computer network that mimics the human brain to learn from large amounts of data. Deep learning is great at recognizing faces in photos, understanding speech, and translating languages. In healthcare, it helps doctors by spotting diseases in medical images. It's also used in self-driving cars to understand the surroundings and make driving decisions. Deep learning is powerful because it can learn from very complex patterns in data. Today, we need special computers to run all these advanced AI programs. AI-optimized hardware includes special chips designed to handle AI tasks quickly and efficiently. Companies like Nvidia and AMD make these advanced chips. These chips are used in many applications, such as self-driving cars, which need to process a lot of data very fast to drive safely. They are also used in medical devices that analyze complex data to help doctors diagnose diseases. With these specialized chips, AI can work faster and more effectively. However, the idea of having complete control over what actions a model can take raises some questions. It's like giving an intelligent assistant all the tools, but putting strict controls on how they can use them. Then there's the full audit log, which tracks everything the model does, the resources and references it uses, and every user prompt. While this might sound great for transparency, it also feels like a form of strict surveillance. One might wonder if this level of oversight is really about adding business value or more about keeping a close watch on the AI to avoid any issues. AIP's main selling point is its ability to integrate AI models into company systems without actually being an AI model itself. It's a delicate balance, offering the benefits of AI while maintaining strict control and oversight. The message behind AIP is designed to appeal to businesses who are cautious about AI's unpredictable nature. But looking deeper, it seems clear. There's a lack of full trust in these models. AI leaders face big challenges and opportunities. Palantir's strategic climb. Palantir's revenue growth, especially in the commercial sector, isn't as clear-cut as it looks. A significant part of this growth comes from existing customers expanding their contracts, not from a surge of new clients. This might mean they're reaching market limits or not attracting a broader audience. While their score of 57 under the Rule of 40 is noteworthy, it's just one measure and doesn't guarantee success. Many high-scoring companies have still faced significant hurdles. In the wider market, Microsoft is the leader in generative AI software, thanks to its strong partnership with OpenAI. This partnership has solidified Microsoft's position, but it also raises questions about their heavy reliance on one relationship. Nvidia, leading in AI hardware, is a close second. Their dominance is clear, but the AI hardware field is always changing, with new competitors emerging. Palantir's focus on government contracts is a double-edged sword. These contracts offer stability and revenue, but they also make Palantir dependent on government budgets and policies, which could limit their growth in the commercial sector, where competition and innovation are critical. Microsoft and Nvidia's top spots are well-deserved, but they have their own challenges. Microsoft's lead in generative AI relies on continuous innovation to stay ahead of fast-moving competitors. Nvidia's strength in AI hardware might be tested by new technologies and companies pushing the boundaries. Nvidia is pulling ahead of the competition at a pace that's hard to match. Their rapid advancements are making it tough for other chip makers to keep up. Nvidia is about to report their earnings, and if they continue to exceed expectations as they have been, they might become the #1 player in the industry. Their consistent success shows their strong innovation and market skills. Meanwhile, Palantir began lower on the list due to many issues last year, starting at number 9. But Palantir has shown that their artificial intelligence platform makes it much easier for different markets to use AI. From national security and heavy industries to finance and drug discovery, Palantir's AIP is making a big impact. Their AIP boot camps have been crucial in helping these industries start using their platforms, which was clear when looked at their earnings data, showing solid growth despite current doubts in the mainstream. Yet, it's worth questioning if everything is as it seems. Nvidia's fast rise and Palantir's surprising comeback seem almost too good, making one wonder about the details behind their success. Are these companies truly as innovative and effective as they appear? Or is there a crafted story keeping investors excited and competitors confused? Nvidia's impressive success raises concerns about competition. Other chip makers are struggling to innovate as quickly, which could lead to Nvidia dominating the market and stifling competition. On the other hand, Palantir's growth with its AIP shows that AI is a powerful tool that can change industries when used effectively. However, the push for more AI adoption also brings up worries about data privacy, ethical issues, and potential misuse in various fields. Palantir's media strategy is clearly working, so it moves up another spot on the list. This is a big move, considering the confidence in the top companies and how far Palantir has climbed over the past 5 months. Understanding how these stocks work is crucial, and there's a video explaining the stock picking process step by step. Palantir's rise is a mix of smart marketing and strategic decisions designed to attract investors and media attention. It's not just about the numbers, but also how they present themselves to the market. They have mastered the art of creating buzz and using it to their advantage, making it seem like they're a rising star. Palantir's growth isn't luck. It's a well-planned effort in public relations and positioning. Every announcement and move they make is designed to keep them in the spotlight and maintain the impression of continuous growth. It's important to look past the hype and see what Palantir is actually offering. Stock picking isn't just about following trends. It's about understanding the basics and seeing through the media spin. So why move Palantir up the list? It's about more than their current performance. It's about their ability to keep the momentum going. It's about how well they can sustain their growth story and continue to convince investors of their potential. The real challenge will be delivering on their promises and maintaining their position in the market. Are Palantir's promises just smoke and mirrors? Comment your thoughts below. If you enjoyed this analysis, don't forget to like, leave a comment, and subscribe for more insights.